Welcome back to GoldTime Tracker, everyone. Today we're diving into a topic that's quietly shaking the global silver markets, the physical shortage of silver and how it's starting to impact industries that rely on it the most. You might think the price of silver is the headline story, but in reality, what matters more right now is access, who can get it and when. Even if silver jumps from $30 to $100 an ounce, the effect on the cost of a $50,000 car is minimal, adding just around $70. That's negligible. But here's the kicker. If car manufacturers can't secure the silver they need, entire production lines grind to a halt. That's the real pressure point. Industries across the globe, from solar panels to consumer electronics to automotive manufacturing, are feeling the strain. Take the solar industry, for instance. Companies like First Solar, Jinko Solar, Trina Solar, and Canadian Solar collectively consume nearly 30% of all silver produced annually. Without a reliable supply, the panels can't roll off the production line. Then there's the tech sector. Samsung, Apple, Nvidia, Intel, Microsoft. They consume roughly 12 to 15% of global silver production. Their output relies heavily on a steady silver supply. And in the automotive sector, giants like Tesla, BYD, Volkswagen, GM, and Ford each need hundreds of thousands to millions of ounces of silver every year. Even though a car contains only around 0.8 to 1.6 ounces of silver, missing that supply is catastrophic if production depends on it. The way silver is delivered to these industries is typically a just-in-time supply chain model. Companies keep maybe 2 to 4 weeks of inventory on hand, expecting new deliveries to arrive just as they need them. But with the current physical shortage, this system is under extreme pressure. Factories are starting to realize that last week's inventory is gone and the next week's shipment might not arrive on time, or at all. That uncertainty forces industries to scramble, negotiating directly with mining companies or suppliers to guarantee deliveries. They may start increasing inventory buffers to 6, 8, or even 10 weeks to ensure continuity. The futures market adds another layer to this story. Analysts like Clive Thompson point out that the real signals aren't coming from price movements or media hype. They're in the internal dynamics of futures contracts. On COMEX, open interest currently sits at around 150,000 contracts, each representing 5,000 ounces of silver. That's a total of 750 million ounces of silver promised for future delivery. However, only 113 million ounces are actually available for delivery. This gap is enormous. Normally, contracts are rolled over before delivery, but we've seen a spike in physical delivery requests over the past year. If even a fraction of these contracts demand delivery simultaneously, the market simply doesn't have enough silver to meet the demand. This shortage is amplified by growing institutional demand. Banks and large investors are securing physical silver rather than paper promises, ensuring they control the metal directly. Meanwhile, industries that rely on silver for production are facing the stark reality of constrained supply. The annual mined production for 2025 is projected at roughly 985 million ounces, but estimated demand is 1.12 billion ounces, a deficit of 117 million ounces. This shortfall highlights just how tight the market has become. For investors and industrial consumers alike, the lesson is clear. Silver is no longer just a commodity or investment vehicle, it's a critical industrial material. The rising volatility and the potential for margin hikes on futures contracts could force liquidations, further intensifying the supply crunch. Companies are racing to secure silver directly, negotiate delivery agreements, and rethink supply strategies. The physical shortage is not a distant problem. It's happening right now, and it's reshaping how the world thinks about silver. Stay tuned to GoldTime Tracker for continuous updates on these developments. With supply tightening and industrial demand surging, silver is entering a phase where access matters more than price. Subscribe and turn on notifications to make sure you never miss critical updates on gold and silver markets. Right now, the silver market is showing signs of a profound structural shift, and it isn't being driven primarily by price speculation. It's about supply and control. Large institutional players are moving to secure physical silver, often bypassing traditional market exchanges entirely. This isn't just paper trading, it's real metal going into vaults and private holdings. Over the past couple of years, entities like Samsung, Tether, and even the Chinese government have been buying silver and gold in their doré form, pre-refined, directly from mines in Mexico, Peru, and other major producers. By doing so, they effectively disintermediate the market, locking up physical metal before it even reaches conventional refiners or exchange channels. This trend highlights the depleting nature of silver deposits. Unlike gold, which has large primary deposits, most silver today is mined as a byproduct of copper, zinc, and lead production. Top primary silver miners like First Majestic produce only a fraction of the total global output. Of the roughly 850 million ounces of silver mined annually, only about 160–170 million ounces come from primary miners. The rest is byproduct. That scarcity drives the behavior we're seeing. Major players are willing to pay premiums or establish long-term contracts to secure supply before anyone else can access it. Compounding this issue is the industrial demand for silver. Solar panels alone consume nearly 30% of global silver production, while technology companies, including Apple, Nvidia, Intel, and Samsung, consume another 12 and 15%. Automakers like Tesla, Volkswagen, GM, and BYD need hundreds of thousands of ounces annually just to keep their production lines running. In many cases, it's not the price of silver that matters most, but the ability to access it. Without a guaranteed supply, production halts, contracts are delayed, and entire industries can experience cascading effects. Futures market dynamics add another layer of complexity. On COMEX, there are currently about 150,000 open contracts of silver, each representing 5,000 ounces. That's 750 million ounces promised, but only 113 million ounces are available for physical delivery. Traditionally, most of these contracts roll over to future dates without requesting delivery. However, there's been an unusual spike in delivery requests over the past year, reflecting a growing desire among traders and industrial players to take actual possession of silver. If this trend continues, it could create acute pressure on the available physical supply. China's role in all of this cannot be overstated. As the world's largest refiner of silver, it controls roughly 60–70% of global refining capacity. With new export restrictions in place, only state-approved refiners can send silver abroad. Non-state actors face strict limitations, effectively keeping massive quantities of silver within China's borders. This creates a global ripple effect. Western industries that rely on refined silver may suddenly find themselves competing for limited resources. The broader takeaway is that silver's market dynamics are shifting from a focus on price to a focus on possession. Those who control the metal now wield power over future production, industrial output, and even geopolitical leverage. For investors, this means volatility may no longer follow traditional patterns. Price spikes or dips are not purely speculative. They often signal shifts in physical ownership and supply security. Industrial buyers, financial institutions, and sovereign actors are all acting in unison to secure physical silver, ensuring they remain insulated from market disruptions and delivery failures. In short, silver is transitioning from a traded commodity to a strategic industrial and monetary asset. Its scarcity, industrial demand, and growing institutional accumulation create a market where access matters more than price. Keeping an eye on these movements is crucial for anyone invested in or reliant on silver. As this new phase unfolds, the global supply-demand balance will likely tighten further, amplifying both market volatility and strategic significance. As we move deeper into the silver market dynamics, one of the most pressing issues is the growing disconnect between paper silver and physical silver. While futures prices and spot prices in the West may give one impression, the reality on the ground, particularly in industrial and Asian markets, is far more constrained. The premium for physical silver in regions like China is already significantly higher than what's reflected in COMEX or London spot prices. This disparity is not a temporary anomaly. It's indicative of structural stress. Large buyers are increasingly willing to pay substantial premiums to secure actual metal rather than relying on paper claims, signaling that possession now matters more than speculative pricing. Unlike past cycles, where price movements were largely speculative, today's market stress comes from tangible shortages that cannot be ignored. Industries relying on silver are beginning to feel the pinch, and the effects of just-in-time supply chains are becoming painfully apparent. When a manufacturer like Tesla or BYD needs 500,000 ounces of silver annually, it isn't the price of silver that threatens production. It's the actual availability. If silver isn't in the supply chain, production lines stop, orders are delayed, and the financial implications ripple across the entire company and its clients. Solar panel manufacturers face an even starker reality, as roughly 30% of global silver production feeds their industry. Companies such as First Solar, Canadian Solar, and Trina Solar must navigate this scarcity carefully. Failing to secure adequate supply could mean months of halted production, and catching up later will be far more costly. Technology companies too are grappling with the physical silver shortage. Giants like Apple, Samsung, Nvidia, and Intel consume about 12 to 15% of total global silver production. For them, scarcity is not an abstract concern, it's an operational risk. High-tech production cannot proceed without silver, so these firms must ensure continuous access, even if it means paying significant premiums or securing long-term supply agreements directly with miners or refineries. What we are seeing is the market's shift from price-driven transactions to supply-driven urgency. In effect, silver has moved from a tradable commodity to a strategic asset, where physical possession matters more than any futures price or paper claim. The futures market itself reflects these tensions. Currently, COMEX shows 150,000 open silver contracts, each representing 5,000 ounces, totaling 750 million ounces of contractual silver obligations. Yet only 113 million ounces are registered as deliverable. Historically, most contracts roll over without demanding delivery, but recent trends show a growing number of investors actually requesting physical metal. If more buyers start demanding delivery, the disparity between contractual obligations and available supply could trigger extreme market stress. Margin increases, forced liquidations, and elevated volatility would follow, but the underlying driver remains simple. There isn't enough physical silver to meet these obligations. Institutional activity intensifies the scarcity further. Large financial entities, including JP Morgan and Citibank, along with major industrial actors, are prioritizing physical possession over paper contracts. These institutions are not trading for short-term gains. They are strategically securing silver as a tangible, irreplaceable asset. This accumulation reduces available supply for other buyers, even as volatility increases. The January delivery period often highlights this dynamic, as index rebalancing and contractual obligations force millions of ounces into institutional hands, leaving less for the broader market. Geopolitical factors, particularly China's policies, compound these supply pressures. China controls a significant portion of global silver refining capacity and has imposed export restrictions, effectively keeping a large amount of silver within the country. Non-state refiners are restricted from exporting, which tightens the physical supply available to the West. Industries that depend on imported silver now face greater uncertainty, and prices may become secondary to the question of who can actually secure the metal. These measures turn silver into a strategic national resource rather than a mere commodity, fundamentally altering global market dynamics. For investors, the key takeaway is clear. Traditional price signals no longer tell the full story. Physical possession, delivery patterns, industrial demand, and geopolitical control now define silver's real market value. Understanding these dynamics provides insight into why premiums are rising, why shortages are being felt across multiple industries, and why volatility in the paper market may not accurately reflect the true state of supply. Silver is transitioning from a commodity largely influenced by speculation into a critical, industrially backed asset whose scarcity is driving both price and strategy. This structural shift makes it essential for investors and industrial buyers alike to pay attention not just to charts, but to the real-world movement and availability of silver. In this context, silver's role as a monetary and industrial metal is increasingly intertwined. As production pressures mount and supply constraints persist, the value of physical silver will continue to rise, not simply as a function of speculation, but because it is an indispensable resource with limited availability. Those who understand this convergence of physical scarcity, institutional accumulation, and industrial necessity will have a distinct advantage in navigating the coming months of market tension and opportunity. As we move deeper into 2025, the silver market is showing signs of stress that go far beyond simple price movements. While many investors focus on charts and forecasts, the true story lies in the physical availability of silver and the way global supply chains are reacting. Major industrial consumers, from automakers to technology firms, are now acutely aware of the risks associated with constrained supply. The automotive industry, for example, uses between 0.8 and 1.6 ounces of silver per vehicle, and with top producers like Tesla, Volkswagen, and BYD manufacturing hundreds of thousands of cars annually, even minor disruptions in silver supply can halt production lines. It's not the cost of silver per ounce that worries them, it's the ability to access it at all. A shortfall of a few weeks in supply could have cascading effects, delaying vehicle production, disrupting sales, and creating knock-on consequences for related industries. Solar energy manufacturers face even more acute risks. Companies like First Solar, Canadian Solar, Trina Solar, and Longi Green collectively consume roughly 30% of global silver production. For them, any disruption in supply translates directly to halted production, delayed installations, and lost revenue. This isn't a scenario of theoretical price spikes. It's a tangible risk affecting real-world operations. As Clive Thompson, a leading analyst, has noted, the current environment is not about price speculation, but about physical availability. Companies are increasingly concerned about securing silver in advance, leading them to negotiate long-term supply agreements or stockpile metal beyond normal operational needs. The once standard, just-in-time supply model is being stretched to its limits, forcing industrial players to rethink how they source and manage their silver inventories. On the investment side, COMEX futures contracts highlight the magnitude of market pressure. With 150,000 open contracts representing 750 million ounces of silver, compared to only 113 million ounces registered as deliverable, a serious imbalance exists between contractual obligations and physical availability. While most contracts are rolled over and do not demand delivery, there's a noticeable uptick in actual physical requests. Should this trend accelerate, it could trigger forced liquidations, margin calls, and extreme market volatility. In other words, the system itself is under stress, and the largest players are positioning themselves to take advantage of this disruption. Institutional accumulation is another key driver. Major financial entities such as JP Morgan and Citibank, as well as industrial giants, are increasingly prioritizing physical possession over paper claims. This behavior signals a strategic shift. Silver is no longer just a tradable asset, it is a critical store of value. When institutions take delivery of millions of ounces of silver, they reduce the liquidity available to smaller investors and industrial users, intensifying scarcity and potentially increasing premiums. January delivery periods highlight this phenomenon, as index rebalancing and contractual obligations funnel large volumes into institutional hands. For investors, this suggests that short-term price fluctuations may mask longer-term structural pressures. Global geopolitics further complicates the picture. China controls roughly 60–70% of the world's silver refining capacity, and recent export restrictions have ensured that much of the silver remains within the country. Non-state refiners now face significant limitations in exporting silver, effectively tightening global supply. For Western industrial users, this creates a bottleneck. Even if silver is available for purchase, it may not be deliverable in the quantities or timeframes needed. This geopolitical dimension transforms silver from a commodity into a strategic resource, with the physical control and logistics becoming as important, if not more important, than market prices. The broader implication is that silver's market dynamics are shifting from speculation to supply-driven scarcity. Investors and industrial players must recognize that physical possession, industrial demand, and geopolitical control now dominate price signals. Volatility in paper markets may no longer reflect the true state of supply, and the ability to secure actual silver is increasingly the key determinant of value. This convergence of physical scarcity, institutional accumulation, and industrial necessity marks a structural shift in the market, signaling that those who understand the real drivers of silver value will have a significant advantage in navigating the months ahead. For long-term investors, the lesson is clear. Silver is no longer just a commodity or a hedge. It is a strategic asset with tangible industrial importance. Supply constraints, combined with increasing industrial and institutional demand, suggest that physical silver will continue to command premium attention. Understanding these dynamics is essential for anyone seeking to make informed decisions in the silver market, as availability, not just price, now dictates the trajectory of this critical metal. As we reach the final part of our deep dive into the silver market for 2025, it's clear that what we're witnessing is more than a typical price rally. It's a structural shift in how silver is valued, held, and consumed globally. Industrial demand, institutional accumulation, and geopolitical control are all converging to create a scenario where physical silver has become increasingly scarce, and its importance extends far beyond simple trading charts. Automotive manufacturers, tech companies, and solar panel producers are scrambling to secure metal, and when production lines depend on just-in-time delivery, any disruption has outsized effects. This physical scarcity, combined with rising demand, has created a market environment where volatility is a feature, not a bug. The data speaks for itself. With COMEX futures showing open contracts for 750 million ounces of silver, but only 113 million ounces available for delivery, there's a significant mismatch between paper promises and real-world metal. The rise in actual deliveries and physical requests indicates a growing preference for tangible ownership over speculative positions. Major financial institutions are capitalizing on this, taking delivery rather than relying on paper claims. This shift signals a broader trend. Silver is increasingly seen as a store of value, a strategic resource, and a hedge against systemic risks, not merely a commodity for short-term trading. Geopolitical factors are adding another layer of complexity. China, controlling 60–70% of global silver refining, has tightened export rules, ensuring much of its refined silver remains in-country. Western industrial users and investors now face restricted access, which compounds scarcity and raises premiums. This underscores an important lesson. In today's silver market, ownership and logistics matter as much as, if not more than, market price. The physical location and accessibility of silver are becoming critical determinants of its value. From an investment perspective, this environment favors those who understand the structural dynamics at play. Short-term volatility may seem intimidating, but the underlying story is about long-term supply constraints, industrial necessity, and strategic accumulation. Investors who focus solely on price swings risk missing the broader narrative. Silver is increasingly scarce, industrially indispensable, and politically sensitive. These factors create a scenario where long-term physical possession can provide both leverage and security. It's also important to highlight the role of ratios in silver valuation. Historically, the gold-to-silver ratio has averaged near 42.1. Currently, it has compressed to the 50s, signaling potential upside for silver relative to gold. Even conservative calculations based on a 20.1 ratio suggest silver could reach well over $200 per ounce if current trends continue. While precise timing is uncertain, the trajectory is unmistakable. Silver's structural value is rising, and savvy investors are positioning themselves accordingly. For industrial consumers, the key takeaway is urgency. The just-in-time supply model is under pressure, and companies may need to expand inventories or secure long-term contracts to ensure production continuity. For investors, it's about recognizing that the market has shifted from speculation to strategic acquisition. Physical silver, whether in bars, coins, or vaulted holdings, is becoming the ultimate hedge against both market volatility and supply risk. Before we close, a reminder for all our viewers. The information provided here is for educational purposes only and should not be considered financial advice. Always do your own research and consult with a licensed financial advisor before making investment decisions. Markets are inherently volatile, and past performance is not indicative of future results. Silver offers unique opportunities, but it also carries risks, particularly in times of structural market shifts like those we've discussed. Thank you for following along through this six-part analysis on the silver market. Stay informed, stay strategic, and remember, understanding the forces behind silver's value is as important as the price itself. Don't forget to subscribe to GoldTime Tracker, hit the notification bell, and join us for regular updates as we continue to track gold, silver, and the forces shaping these precious metals markets.